Imagine a ship setting sail with extra canvas to catch more wind, hoping to speed to its destination. While this can accelerate its journey in fair weather, what happens when a storm hits? In the financial world, leveraged portfolios operate with a similar dynamic. Yes, market downturns absolutely can amplify losses for leveraged portfolios, often significantly more than for unleveraged ones. This occurs because the use of borrowed capital magnifies both gains and losses. The core mechanism behind this amplification is financial leverage, which involves using borrowed money to increase potential returns. When a portfolio is leveraged, a relatively small percentage decline in the underlying assets translates into a much larger percentage loss on the equity invested, because the principal amount of the loan still needs to be repaid regardless of asset performance. This effect is often exacerbated by margin calls, where lenders demand additional collateral to maintain the required loan-to-value ratio, forcing investors to either inject more capital or liquidate positions at unfavorable prices, thus turning paper losses into realized ones. To understand this impact, consider a portfolio that uses a 100% leverage ratio. This means for every dollar of the investor's own capital, another dollar is borrowed. If the underlying assets decline by 10%, the investor's equity, after repaying the loan, would effectively suffer a 20% loss, assuming no change in the value of the debt itself. This relationship becomes even more critical in highly volatile markets, where rapid price movements can trigger multiple margin calls in quick succession, creating a cascade effect. One insider detail to consider is the concept of a convexity trap in certain leveraged strategies, especially those involving complex derivatives or structured products. In these scenarios, the sensitivity of the portfolio to market movements, known as its delta or gamma, can change unfavorably during downturns. For instance, the delta of an option position might increase dramatically as the underlying asset price falls, meaning the portfolio becomes even more exposed to further declines precisely when market conditions are at their worst. Understanding this dynamic is crucial for managing the nonlinear risks associated with advanced leverage applications. Ultimately, the amplified losses in leveraged portfolios during market downturns underscore the critical importance of robust risk management and a thorough understanding of financial engineering. It highlights how the quest for enhanced returns through leverage inherently introduces symmetrical exposure to both upside potential and downside risk, making the analysis of capital structure and market volatility paramount for investors in alternative strategies.